In this video, we're going to take a look at some high-yielding dividend stocks in my own portfolio that have never gone through a dividend cut and currently have very comfortable dividend payout ratios. What that means is, according to these companies' most recent financial results, none of these stocks are struggling to pay their dividends. Of course, there could always be some kind of corporate scandal or nuclear war or some other unforeseen situation going on. However, according to each of these companies' most recent financial results, everything appears to be very healthy for these companies. At the end of the day, all we can do is go off what these companies are revealing to us in their most recent quarterly results. For each position, I'll calculate how well covered their dividends are so we can see how comfortable of a buffer each holding currently touts. But they all usually have very long histories of paying dependable, high-yielding distributions. So with that being said, let's look at our first company. The first stock that just posted another really solid quarter is Main Street Capital, ticker MAIN. This is a business development company which makes debt and equity investments in small to medium-sized businesses. Their investments are typically made to support management buyouts, recapitalizations, growth financings, refinancings, and the acquisitions of companies that operate in diverse industry sectors. Main Street seeks to partner with entrepreneurs, business owners, and management teams and generally provides one-stop financing alternatives within its lower middle market portfolio. This BDC currently has the best track record in their entire sector. Since their launch in late 2007, which was the worst time to start a BDC because of the GFC, this company has never gone through a dividend cut. They've grown their dividend by 132% since their IPO, and on top of that, they also pay monthly dividends. Main Street also regularly pays supplemental, or in other words, special dividends, which are basically added bonuses on top of their regular normal dividend payments. On May 8th, this company released their Q1 results of 2025, which were full of good news. They announced they earned distributable net investment income of $1.07 per share. Main Street currently pays 25.5 cents per share in dividends each month, so we need to multiply that by 3 since these results are reported quarterly. $1.07 divided by 76.5 cents means that Main Street Capital's dividend is currently 139% covered. Out of all the BDCs that currently exist, Main Street Capital, according to my knowledge, has the highest dividend coverage out there. They also grew their net asset value by 1.2% compared to their previous quarter, which might not sound like much, but it's actually pretty solid. However, not everything from their most recent quarter was good. They did announce an increase in non-accruals, which is the percentage of investments in their portfolio that aren't paying interest. That came out to 1.7% at fair value and 4.5% at cost. It was a jump from their previous quarter, which was 0.9% fair value, 3.5% at cost. Despite that jump in non-accruals, they only earned 1 penny less than their previous quarter, so they're still reporting good coverage. So overall, this stock has kept performing exceptionally well. I have criticized the fact that it's been very overvalued for a very long time, and it still is. However, it's more appealing today given this stock's drawback in share price since its all-time high 3 months ago. The next stock we'll look at with excellent dividend coverage is MPLX. This company owns and operates midstream energy infrastructure and logistics assets in the United States. They're involved in the gathering, processing, and transportation of natural gas. In fact, 10% of all natural gas produced in America is handled by MPLX. They're also involved in the gathering, storage, transportation, and distribution of crude oil and refined products. MPLX provides services in the midstream sector across the hydrocarbon value chain through their logistics and gathering segments. This stock is a master limited partnership and will complicate your taxes by sending you a K-1 tax form that you must file with your income taxes. Much like Main Street Capital, MPLX has long posted some really outstanding metrics. They also have a perfect dividend track record that's never been cut in their history. You can see in their latest investor presentation that their distributable cash flow has a compound annual growth rate of 6.9% per year, and their quarterly distribution growth has a 10.7% compound annual growth rate. Since their launch in 2013, this company has grown their distributions from 13 cents per unit to 96 cents per unit. That means they've grown their original distribution rate by 638% in 12 years. You'd be really hard-pressed to find a company that offers that kind of growth and the high yield that it offers. That's the great thing about MLPs. Many are great at growing their distributions and maintaining a high yield at the same time, as long as you're okay with the tax consequences. MPLX released their latest earnings on May 6th, and they again posted some really good growth numbers. Net income, EBITDA, and distributable cash flow all grew compared to their previous quarter last year, and every major metric is up from this time a year ago. They reported that their current distribution is 150% covered by their distributable cash flow. That makes it the most well-covered distribution out of anything I currently hold in terms of an individual company and not an ETF or a closed-end fund. Coverage did fall slightly from their previous quarter, where it was 160% covered according to their financials, but overall, MPLX is still reporting really outstanding numbers. Another company with good dividend coverage right now is Sixth Street Specialty Lending, ticker TSLX. They're a business development company that provides senior secured loans, unsecured loans, mezzanine debt, and investments in corporate bonds and equity securities. According to their website, it says, "Our creative financing delivers fully underwritten solutions in a variety of industries and across the spectrum of the capital structure. Our unique portfolio construction allows us to manage a well-diversified, low-volatility current yield portfolio. This approach provides benefits to both our financing partners and our investors." This BDC, in my opinion, doesn't get the fanfare that it truly deserves. It is externally managed, which is less appealing than an internally managed BDC, but despite that, they're one company in this category of BDCs that's performed exceptionally well. Just like all the other companies we've looked at, TSLX has never gone through a dividend cut, and they pay a lot of special dividends. Only in 2 quarters in the past 8 years did they not pay an additional dividend on top of their regular quarterly distribution. Historically, they've also had pretty good NAV growth compared to their peers. This stock is also the highest yielding one that we're going to take a look at today, with TSLX offering a yield close to 10%. Sixth Street Specialty Lending submitted their most recent results on April 30th. In the press release, the company announced they earned 62 cents in net investment income from their portfolio of mostly senior secured debt in the previous quarter. In the same quarter, they also announced a regular dividend distribution of 46 cents per share and a special dividend of 6 cents. For the purpose of calculating a dividend payout, the special dividend will not be included. Although the supplemental payments are nice, it's the base dividend that we want to focus on and make sure that that is healthy. In Q1 of 2025, TSLX had their dividend coverage at 134%. Not as high as Main Street Capital, but this is still very likely one of the best coverages among BDCs, maybe even second to Main Street. They did see their net asset value go down compared to their previous quarter, and it actually went down quite a bit lower than what's typical. This was due to a markdown stemming from one of their investments that was on non-accrual. Speaking of which, this company's non-accruals were only 1.2% of their portfolio as of Q1, which is much lower than the BDC average. But going off their latest earnings, this stock is still doing very well and healthy. They do have the same problem as Main Street, which is their stock is almost always, including right now, pretty overvalued. It's just a fact that when it comes to quality, the market is just willing to pay a premium price for it. But that's going to wrap up our look at some high-yielding stocks that have perfect payout streaks and are healthy based upon their most recent results. Of course, it's always possible that things could drastically change from one quarter to the next, and there could always be some kind of scandal going on. But based upon all the public information that we have available, all of these companies are still doing very well. Let me know if you're a fan of any of these companies yourself, or if you know of any other high-yielding stocks with really great payout records. But with that being said, thanks for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher-yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.